Welcome to Investor's Guide, a brand new episode of a show that's held your hand for the last 7 years when it comes to investing your money. We're going to do so this week as well. First of all, email ID is at the bottom of your screen. You can reach us about anything to do with your money. Over the next half hour, we'll take a look at our income growth portfolio. This is meant for someone who's already retired. In our product review, we look at the Franklin India High Growth Companies Fund. We'll tell you if you should continue to invest in that fund. And what is an option better than the savings bank account in terms of returns? Almost everything else. That's coming up later on the show. I bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for coming into the show again. All right, so it's time to look at our income growth portfolio. Now, this portfolio was designed by Dhirendra 9 years ago, and it's meant for someone who's already retired, who's looking to beat inflation. Now, these are the funds in the portfolio. There's the FT India Dynamic P ratio, the HDFC MIP, the Reliance MIP, and the UTI Balanced. Dhirendra, we get a lot of emails from people who write in who are already retired or approaching retirement. It's a huge category of investors who need to be looked at more carefully by this entire industry. Now, let's assume the person has already taken advantage of the senior citizen savings scheme. Is this the second option? Because this portfolio has given us a return round about a little over 10%, which is impressive given the kind of markets we've had over the last 7 years. 10% is an excellent return. So is this ideally what retired people should be using?
Yeah, absolutely. It is very important for people in retirement to ensure that a good part of their investment is invested in a manner that will be able to beat inflation, and you have no choice but to invest a part of your money, part of your accumulation in equity in a calibrated manner, in a vehicle which is not disappointing, because it is also managing your own mind when investing. If you invest in something which will definitely beat index beat inflation, beat fixed income by a wide margin, but in between it drops freely. That is very discomforting for most people in retirement, because your mindset changes when your regular income stops from work, and you get more apprehensive, and understandably so. So the investment should be configured moderately for that, but at the same time, this portfolio has worked very nicely for most investors, because what we have planned here is targeted a 40% allocation to equity, but through vehicle, but through investments which are more stable. They don't disappoint you whenever you take a look at them. And we have also designed a periodic withdrawal plan which is tax efficient. So in that sense, given that periodic withdrawal and that looking at total return generated from this portfolio is quite impressive.
Well, it's an impressive portfolio, and those funds are on your screen one more time. If you have questions about it, you can get back in touch with us. I'll just go through those funds. This is the FT India Dynamic P ratio, the HDFC MIP, Reliance MIP, and the UTI Balanced Fund. It's time to move on to our financial plan segment. Our profile today is of a 38-year-old woman with a young child. Her goal is to hit a target of 2 crore rupees for her own retirement and money for her child's future. This is Rekha Mukherjee, Dhirendra, who's in from Bangalore. She wants about 25 lakh rupees for her daughter's education in the next 15 years and 2 crore rupees for her own retirement. Her daughter is 2 years old. So Rekha's currently on a sabbatical. She's been on a sabbatical for the last 10 months, and she plans to begin working again in the next 4 months. Now, she's gone over all of the details, Dhirendra. Now, most of it is absolutely brilliant. She and her husband both have term policies of over 1.5 crore rupees. They have health insurance that they've bought along with what their employers give them. They've paid off their entire home loan. They have a 4 lakh rupee emergency fund. It seems like everything beautifully taken care of. Until we reach the point where we talk about their mutual funds. Now, she writes in saying that she stopped investing in mutual funds. She has too many funds. There's 29 funds in her portfolio. There seems to be some sort of, a mismatch in the communication on how she picks her funds. You don't have to, Rekha, pick a new fund every time you invest in mutual funds. You don't have to stop investing in mutual funds because you have too many funds. And it must be something that is a misunderstanding for a lot of our viewers and investors, Dhirendra, to say, I have too many funds, so I'm going to stop investing altogether. To begin with, 29 funds is far too many.
I don't see a logic here. I don't see a rationale, but it can be fixed very quickly. It does not require serious effort. one should be conscious of two things. One is that decide on the 3-4 fund that you must have. Make sure that you have a multi-cap fund of the respective fund families. You have, funds from 6 fund families. Just have the multi-cap funds given your investment time frame, given your goals, and start your SIP there. Shift your money from all over as and when, because she also has quite a few tax saving funds. As and when the money gets out of the lock-in, it will also be free from capital gains tax. Move that money. All other investments, all SIPs which you have stopped, once your last installment is more than 1 year old, which means all your money will be free from capital gains tax. And that money you can consolidate it in the same 3-4 funds. You don't need to really stagger your investment accumulated in your SIP, because that money is invested in equity funds already. You don't need to do SIP by realizing this money and then starting it all afresh, because you are exposed to the market, and that is needed for people who are getting a lump sum, and they will be disappointed if soon after their investment the market slips. This portfolio can be fixed with these two, keeping in mind these two things.
Portfolio can be fixed keeping in mind these simple things, that you don't need so many funds in your portfolio. Simplify your portfolio. Start moving money out and consolidating. Dhirendra, it's quite a wide choice. Of the 29 funds that she has in her portfolio, if you were to, trim it down to 4 or 5 funds that complement each other, that can do the job of putting together her retirement fund and the fund that she wants to put together for her child, which of these funds would you recommend she holds on to?
Yeah, if I have to, build a portfolio, because this has to be a long-term portfolio given her goals, I'll choose 3-4. I'll basically suggest 3-4 multi-cap fund, the truly diversified fund, which means that she'll have to sell most of the funds she owns. And if to choose some, I have very few to choose from. The only 2 funds which I would like to have from the existing portfolio is Reliance Equity Opportunity and ICICI Prudential Value Discovery Fund. Rest of the tax saving funds and all other equity funds has to be sold and consolidated in these these 2 funds. Plus add 2 more multi-cap fund. If I have to recommend them, I would say Mirai Asset Mirai Asset India Opportunity Fund, or adding Birla Sun Life Frontline Equity. These are the mainstream funds that will get you exposure to all the segments of the market. May retain 2 mid-cap fund just to keep the aggression in the portfolio, but don't have more than 4 to 6 funds.
Don't have more than 4 to 6 funds. That's that's a directive we should all pick up when we plan our portfolios. This is something we've been saying on Investors Guide for a very long time. The more number of funds you have, the more you have to track, the more you have to keep an eye on it. And the important thing here is to remember, time you start a new investment, you don't have to start it in a new fund. You can just continue to invest in the funds you're already holding if they're working fine for you. So key takeaways before we take a break: simplify your portfolio. 4 or 5 diversified funds is all you need. If you're retired, you still need to beat inflation. Just putting your money in a fixed deposit is not enough. You're going to have to consider something that will give you better returns than a fixed deposit. So even a tiny little exposure to equity is important. It's time to look at the Franklin India High Growth Companies Fund. Avan is here to give us the numbers. Avan.
Thanks, Faye. This week, we take a look at the Franklin India High Growth Companies. With 5 stars on value research, this fund has had stellar returns over the long term. Let's take a closer look at its performance over the last 5 years. The red line is the fund and the blue line is the benchmark. You see that the fund's performance has been better than its category and benchmark during the bull and bear phases of the market. In the last 1 year, however, the fund's performance slipped by a margin with a return of a negative 1%. In fact, its peers have had better returns than this fund in the last 1 year. But the long-term investors need not be worried. The fund has outperformed its peers over the long term with a return of 20%. Is this fund a must-have in your portfolio? Let's find out. With that, it's back to you, Faye.
Thank you for those numbers. Dhirendra, Franklin India High Growth Companies Fund obviously has a 5-star rating on value research, which is tough to get in a market like this. We've had a sort of run where mid-caps have done well over the last 1 year. Would you say this particular fund stands out from the rest of it, and this is something that most aggressive investors could consider keeping in their portfolios?
No, I would say that this fund remains a multi-cap fund. It is dominantly into large caps, marginally into mid caps, and it classified as a multi-cap fund, and it had a very it follows its mandate very carefully, high growth companies fund, and it is focused on that. And this is a strategy which on occasion doesn't work. These funds, the growth-oriented companies, they command high PE and they also fall more sharply in case of a market turnaround. So, but then it has been true to its mandate. It has been in high growth companies, and what we have seen in the last 4 or 5 years is it has worked very well. The stock selection has just been has worked, and in a country like India, where I feel that equity investing is all about growth, it is not about value, it is not about looking at the downside, and this strategy works very well if an investor is able to stick through a full market cycle, and that is what this fund's top rating is also proving.
So, Dindra, what's your final rating on the Franklin India High Growth Companies Fund on Investors Guide? Would you recommend it as a must-buy for anyone looking for a multi-cap fund?
Yes, if somebody looking for aggressive growth can withstand the intermittent decline, at the same time not a questionable portfolio, it is a very strong 5-star.
A very strong 5 stars there for this fund. 5 stars is difficult to come by on this show. So it is a very strong fund to keep an eye on. Let's move on to our next segment, which is called Buy a Home. 35-year-old NRI Sajan Matthews has written in Virendra. He moved from Delhi to Muscat about a year ago. He has a term plan, health insurance, emergency fund all in place. He wants to save 1 crore rupees to buy a home in the next 10 years. He also wants to save enough for his children and his own retirement, but his primary goal is to buy a home. He's been investing 5,000 rupees a month in the ICICI Prudential Value Discovery and Pro Infrastructure since 2014. What is he going to have to do to achieve his goal? 1,000 rupees a month is not going to do it. What do you recommend he does?
Save more and keep away from anything exotic, and infrastructure fund is one such thing. So make these 2 changes: save as much as you can, and make sure that you have enough accumulation to put your down payment and maybe more. And at this stage, you should also consider that the SIP that you are doing, if that goes by way of as EMI, that can take care of it. And once you think you have enough accumulated, go for it. At your investment with regularity, and drop the infrastructure fund, even though it might do well in coming times, but you'll be much better off. We have seen this expectation being built many times, and nothing prevents a normal fund to be emphasizing infrastructure companies, but investing in an infrastructure fund is a disadvantage because it can't diversify beyond these.
The infrastructure fund is not a great idea. Dhirendra, what about the other fund that he has right now? So he has the infrastructure fund, he also has value discovery. Can he continue to hold that fund?
Yes, he should not only consider to hold that fund. If he's going to just invest in one fund, that could well be the fund. Value discovery has changed colors, and it is so impressive a fund. If you look at the 10-year SIP return, it turns out to be one among the finest fund. It has changed its complexion as it has turned big. It has not been disappointing over any 3-4 year time frame. So it looks like an excellent choice. And so he should just diversify beyond this fund manager to an extent possible. If he's going to invest more, maybe add 1 or 2 more funds, and that should be enough.
And for 1 or 2 more funds, I'm going to put up our recommendation of multi-cap funds here on this show. That's on your screen right now. So it's very simple. You're on the right track. You've checkboxed all the insurance and the emergency fund. What you need to do now is aim to at least put together your down payment by increasing your savings amount every month. The funds that are on your screen at this point. Avoid the exotic infrastructure funds. Dhirendra, thank you so much for joining us on the show this week and helping us with our questions. It's time to answer questions on asset allocation, and Karthik Zaveri has joined us this week. Karthik, our first question comes in from Hari Om Singh. He has about 1 lakh rupees in his savings bank account, and he wants to know where to invest it to get a higher return than what his bank account is giving him. Now, obviously, you shouldn't leave your money in your bank account because at 4% or even 6%, it's not even beating inflation, so you're losing money. Now, Karthik, the problem is he hasn't told us what he wants to do with this money, whether it's money he's going to be putting aside for the long term But just to beat the bank account return, what are his options?
So the best thing for someone like you and a lot of other people who want to invest money into something which is like a fixed deposit, which gives you a fixed rate of return, but obviously nobody is happy with that rate of return because what you're getting today is in the range of about 7.25, maybe 7.5. So the only and the very short kind of a way of improving that return is to go into what we call as bond funds, and within bond funds, category of liquid funds, ultra short term bond funds. If you have a slightly longer time frame, you could also look at what is known as the category of medium term bond funds, wherein the chances of return are a little higher. So what plays here is the volumes of money that the mutual fund scheme is handling, and retail investors like all of us put in our money into these schemes. These schemes then ultimately go and invest into fixed deposits and corporate deposits, government securities. Various portfolios are made comprising of these kind of assets. Money does not go into equity, so therefore you don't have that kind of a risk of loss of capital, which is which could actually deter you from getting your fixed interest investment income. So therefore you can consider investment in some of these kind of instruments, and these instruments are great because most of these instruments do not have a lock-in period, they don't have an entry load, they don't have an exit load, so you can pretty much get your funds inside, enjoy a rate of return in the range of about 8.5% to maybe 9, sometimes even 9.5%. You can invest for any number of days that you want, right from 1 day to as long as you want to be invested into it, and whenever your need for money arises, you can simply put in a redemption request, and by doing the redemption, the money should come to your account within 24 hours of your request of redemption, or at the most the day after if you've put in your request after the cutoff time on a particular day. So this is a great option for you. Put your money inside, you will definitely be able to earn at least 1 or 2% more than what your fixed interest can give you.
And a question comes in from 20-year-old Raj Agarwal, who wants to invest 4,000 rupees a month in mutual funds for the next 5 to 10 years. He wants a return of 15 to 20%. What should he do and how should he go about investing? Well, 15 to 20% if he's going to invest for the next 10 years is not a bad assumption. Karthik, how should he go about picking those funds?
Raj, one of the first things that I want to tell you right at the outset is, if you are going to do an SIP from a 5 to 10 year perspective, it may or may not work out for you. Now, the reason I say that is because a business cycle on an average is in the range of about 4 to 8 years. So which means if you are doing, and that is for a single lump sum investment. So if you are doing a regular SIP kind of investment, your time frame pretty much sort of doubles, somewhere in the range of maybe 8 years to about 15 years. So whether you want to continue to do it for such a long period of time or not is something that you want to really think about very seriously, and then go ahead and do this thing. Because remember, each installment of yours, let it be considered like a single investment, and then that single investment needs that 4 to 8 years of average time frame. So therefore, when you're doing a 5-year or a 10-year SIP, the last installment of your 5th year or the 10th year will also need that much period. You might have intermittent periods where if you are in a situation of a rally, you might actually see a lot of great profit, but there could also be times where you may not see so much of profit. So therefore, understand that it's a very long kind of an investment, but the rewards are certainly worth the long time that you're going to be into it. Now, to give you a mathematical estimate of the same, 5,000 rupees if you tend to invest, and if you do this over a regular period of 20 years time, then the kind of return that you're expecting, 15-20%, will surely happen. And even at a 14% estimate, you will be able to accumulate close to about 65 lakhs, which is a substantial sum, just from a small amount like 5,000 rupees invested for 20 years. So think about this in this fashion and then go about making your portfolios. What you can do is you can start with a diversified large cap kind of scheme, and as your surplus increases, then you can diversify even furthermore and pick up a SIP into a mid cap fund, then maybe pick up an SIP into some sectoral funds, and that's how you go about building your SIP portfolio step by step.
Question comes in from Vinod Kumar. Vinod Kumar has been investing in 4 mutual funds, and he tells us obviously there's a difference between direct funds and regular funds, and the returns on direct funds are higher. He wants to know how that works and whether he should switch all of his funds right now into the direct mode. Well, to put it very simply, what happens when you buy a direct fund directly on the website of the company that's issuing that fund is that you take away the middleman or the agent. And the amount of money that's saved by not paying commission to the agent is passed on to you directly as a customer. and of course you make that extra profit. Karthik, in my mind, the only challenge, of course, with buying all your funds directly is that a lot of times people think that they don't need advice, but they actually do. How can a customer tell the difference between needing advice and not needing advice?
So, you see here what we need to understand is the concept of expense charges that most of the mutual funds levy to manage your money. So, what happens in these expense charges, and which is technically known as the expense ratio of a particular mutual fund scheme, is that your expense ratio in case of a direct mutual fund is lesser. It is lesser because there is no intermediary, there is no mutual fund distributor, there is no advisor involved who is getting a certain small commission out of this investment that you are doing. Now, what happens is here, the consideration is that if you are in a situation where you pretty much understand how to analyze mutual fund schemes, do research on it, make your own investment decision, then you are able to monitor it and you are able to continue your investment into it for many years, then it's definitely a great idea, because obviously, effectively, because your costs are lower, therefore your returns will be naturally automatically higher. You are not getting any additional units in regular funds or anything of that sort. It's just that in the regular fund, there is an intermediary who is involved, who is your financial consultant, who will be guiding you in case you don't understand. He'll be providing you great advice in terms of where should you invest the money, what kind of asset allocation should you follow, what is the market situation looking like, what is the economic situation looking like, and you will be making decisions along with the advice of your advisor. So that's the real difference. So long as you are able to manage things independently, direct is a great option to go with. And coming to your portfolio per se, your schemes look absolutely fine. These are good schemes. They've got good historical background and performance. So you might continue with them. There is no harm in doing so. As you sort of move along with more investments, that time you can consider going into other categories of equity mutual funds, such as mid caps, such as small caps, such as international funds, dividend yield funds, etc. Those would add a little bit of diversity and variety into your portfolio, which is currently largely centered around being large cap oriented. So you may want to think about changing your orientation in years to come.
That's a wrap on Investors Guide. As always, we'll be here next week to answer your questions about money. Send in emails to the email ID that's at the bottom of your screen, or you can reach me personally on Twitter. Thanks for watching.